employees and to its stockholders. An extraordinarily large amount of stock was bought for the benefit of these employees at what seemed to be an attractive price. All the money to carry these shares was supplied by the stockholders. If the business had improved, the value of the stock would have advanced greatly, and all the benefits would have gone to the employees. When things became worse, those in managerial positions were relieved of any loss, and the entire burden fell upon the stockholders. In its transactions directly with its stockholders, we see White Motor soliciting $10 million in new capital in 1926. We see some of this additional capital, not needed to finance sales, employed to buy back many of these very shares at 1/5 of the subscription price. The passing of the dividend was a major factor in making possible these repurchases at such low quotations. The facts just related without further evidence might well raise a suspicion in the mind of a stockholder that the omission of the dividend was in some way related to a desire to depress the price of the shares. If the reason for the passing of the dividend was a desire to preserve cash, then it is not easy to see why, since there was money available to buy in stock. There was not money available to continue a dividend previously paid without interruption for 15 years. The spectacle of a company overrich in cash passing its dividend in order to impel desperate stockholders to sell out at a ruinous price is not pleasant to contemplate. Westmoreland Coal Company, another example. A more recent illustration of the dubious advantage accruing to stockholders from a policy of open market repurchases of common stock is supplied by the case of Westmoreland Coal. In the 10 years 1929 to 1938, this company reported a net loss in the aggregate amounting to $309,000 or $1.70 per share. However, these losses resulted after deduction of depreciation and depletion allowances totaling $2,658,000, which was largely in excess of new capital expenditures. Thus, the company's cash position actually improved considerably during this period, despite payment of very irregular dividends aggregating $4.10 per share. In 1935, according to its annual reports, the company began to repurchase its own stock in the open market. By the end of 1938, it had thus acquired 44,634 shares, which were more than 22% of the entire issue. The average price paid for this stock was $8.67 per share. Note here the extraordinary fact that this average price paid was less than 1/2 the cash asset holdings alone per share, without counting the very large other tangible assets. Note also that at no time between 1930 and 1939 did the stock sell so high as its cash assets alone. At the end of 1938, the company reported cash and marketable securities totaling $2,772,000, while the entire stock issue was selling for $1,400,000. If this situation is analyzed, the following facts appear clear. 1. The low market price of the stock was due to the absence of earnings and the irregular dividend. Under such conditions, the quoted price would not reflect the very large cash holding theoretically available for the shares. Stocks sell on earnings and dividends, and not on cash asset values, unless distribution of these cash assets is in prospect. 2. The true obligation of managements is to recognize the realities of such a situation and to do all in their power to protect every stockholder against unwarranted depreciation of his investment, and particularly against unnecessary sacrifice of a large part of the true value of his shares. Such sacrifices are likely to be widespread under conditions of this kind because many stockholders will be moved by necessity or the desire for steady income or by a discouraged view of the coal industry to sell their shares for what they can get. 3. The anomaly presented by exceptionally large cash holdings and an absurdly low market price was obviously preventable. That the company had more cash than it needed is confessed by the fact that it had money available to buy in cheap stock. even if it were not evident from a study of the unusual relationship between cash holdings and annual business done. 4. All cash that could possibly be spared should have been returned to the stockholders on a pro rata basis. The use of some of it to buy in shares as cheaply as possible is unjust to the many stockholders induced by need or ignorance to sell. It favors those strong enough to hold their shares indefinitely. It particularly advantages those in control of the company, for in their case, the company's cash applicable to their stock is readily available to them if they should need it, since they could then bring about a distribution. Just because this situation is distinctly not true of the rank and file of the stockholders, the market discounts so cruelly the value of their cash when held by the company instead of themselves. Summary and conclusion. The relationship between stockholders and their managements, after undergoing many unsound developments during the hectic years from 1928 to 1933, have since been subjected to salutary controls, emanating both from SEC regulation and from a more critical viewpoint generally. Certain elementary facts, once well nigh forgotten, might well be emphasized here. Corporations are, in law, the mere creatures and property of the stockholders who own them. The officers are only the paid employees of the stockholders. The directors, however chosen, are virtually trustees, whose legal duty it is to act solely in behalf of the owners of the business. To make these general truths more effective in practice, it is necessary that the stock-owning public be educated to a clearer idea of what are the true interests of the stockholders in such matters as dividend policies, expansion policies, the use of corporate cash to repurchase shares, the various methods of compensating management, and the fundamental question of whether the owner's capital shall remain in the business or be taken out by them in whole or in part. Chapter 45. Balance Sheet Analysis concluded. Our discussion in the preceding chapters has related chiefly to situations in which the balance sheet exhibit apparently justified a higher price than prevailed in the market. But the more usual purpose of balance sheet analysis is to detect the opposite state of affairs, viz., the presence of financial weaknesses that may detract from the investment or speculative merits of an issue. Careful buyers of securities scrutinize the balance sheet to see if the cash is adequate, if the current assets bear a suitable ratio to the current liabilities, and if there is any indebtedness of near maturity that may threaten to develop into a refinancing problem. Working capital position and debt maturities. Basic rules concerning working capital. Nothing useful may be said here on the subject of how much cash a corporation should hold. The investor must form his own opinion as to what is needed in any particular case, and also as to how seriously an apparent deficiency of cash should be regarded. On the subject of the working capital ratio, a minimum of $2 of current assets for $1 of current liabilities was formerly regarded as a standard for industrial companies. But since the late 1920s, a tendency towards a stronger current position developed in most industries, and we find that the great majority of industrial corporations show a ratio well in excess of 2 to 1. There is some tendency now to hold that a company falling below the average of its group should be viewed with suspicion. This idea seems to us to contain something of a logical fallacy, since it necessarily penalizes the lower half of any group, regardless of how satisfactory the showing may be, considered by itself. We are unable to suggest a better figure than the old 2 to 1 criterion to use as a definite quantitative test of a sufficiently comfortable financial position. Naturally, the investor would favor companies that well exceed this minimum requirement, but the problem is whether or not a higher ratio must be exacted as a condition for purchase, so that an issue otherwise satisfactory would necessarily be rejected if the current assets are only twice current liabilities. We hesitate to suggest such a rule, nor do we know what new figure to prescribe. A second measure of financial strength is the so-called acid test, which requires that current assets, exclusive of inventories, be at least equal to current liabilities. Ordinarily, the investor might well expect of a company that it meet both the 2-to-1 test and the acid test. If neither of these criteria is met, it would in most cases reflect strongly upon the investment standing of a common stock issue, as it would in the case of a bond or preferred stock, and it would supply an argument against the security from the speculative standpoint as well. Exceptions and examples. As in all arbitrary rules of this kind, exceptions must be allowed if justified by special circumstances. Consider, for example, the current position of Archer Daniels Midland Company on June 30, 1933, as compared with the previous year's figures. These figures may be found in the accompanying PDF. The position of this company on June 30, 1933 was evidently much less comfortable than a year before, and, judged by the usual standards, it might appear somewhat overextended. But in this case, the increase in payables represented a return to the normal practice in the vegetable oil industry, under which fairly large seasonal borrowings are regularly incurred to carry grain and flaxseed supplies. Upon investigation, therefore, the analyst would not consider the financial condition shown in the 1933 balance sheet as in any sense disturbing. Contrasting examples on this point are supplied by Douglas Aircraft Company and Stokely Brothers and Company in 1936 to 1938. Please reference the chart found in the accompanying PDF. The situation in Douglas Aircraft in 1937 was not a seasonal matter, as in the case of Archer Daniels Midland, but grew out of the receipt of certain types of orders requiring considerable working capital. Upon inquiry, the investor could have satisfied himself that the need for bank accommodation was likely to be temporary and that, in any event, the new business was sufficiently profitable to make any necessary financing an easy affair. The Stokely picture was quite different, since the large current debt had developed out of expanding inventories in an unprofitable market. Hence, the May 1937 balance sheet of Stokely carried a serious warning for the preferred and common stockholder, as the table shows. A year later, Douglas Aircraft had paid off its bank loans and showed a current ratio of 4-to-1. Stokely suspended preferred dividends in October 1938, and in that year the price of the issue fell from 21, par $25, to 10. As we pointed out in our discussion of bond selection, Chapter 13, no standard requirements such as we have been discussing are recognized as applicable to railroads and public utilities. It must not be inferred therefrom that the working capital exhibit of these companies is entirely unimportant. The contrary will soon be shown to be true, but only that it is not to be tested by any cut-and-dried formulas. Large bank debt frequently a sign of weakness. Financial difficulties are almost always heralded by the presence of bank loans or of other debt due in a short time. In other words, it is rare for a weak financial position to be created solely by ordinary trade accounts payable. This does not mean that bank debt is a bad sign in itself. The use of a reasonable amount of bank credit, particularly for seasonal needs, is not only legitimate but even desirable. But whenever the statement shows notes or bills payable, the analyst will subject the financial picture to a somewhat closer scrutiny than in cases where there is a clean balance sheet. The post-war boom in 1919 was marked by an enormous expansion of industrial inventories carried at high prices and financed largely by bank loans. The 1920 to 1921 collapse of commodity prices made these industrial bank loans a major problem. But the depression of the 1930s had different characteristics. Industrial borrowings in 1929 had been remarkably small, due first to the absence of commodity or inventory speculation, and secondly to the huge sales of stock to provide additional working capital. Naturally, there were exceptions, such as, notably, Anaconda Copper Mining Company, which owed $35 million to banks at the end of 1929, increased to $70,500,000 3 years later. The large bank borrowings were shown more frequently by the railroads and public utilities. These were contracted to pay for property additions or to meet maturing debt, or in the case of some railways, to carry unearned fixed charges. The expectation in all these cases was that the bank loans would be refunded by permanent financing, but in many instances such refinancing proved impossible and receivership resulted. The collapse of the in-sole system of public utility holding companies was precipitated in this way. Examples. It is difficult to say exactly how apprehensively the investor or speculator should have viewed the presence of $68 million of bank loans in the New York Central balance sheet at the end of 1932, or the bills payable of $69 million owned by City Service Company on December 31, 1931. But certainly this adverse sign should not have been ignored. The more conservatively minded would have taken it as a strong argument against any and all securities of companies in such a position, except possibly issues selling at so low a price as to constitute an admitted but attractive gamble. An improvement in conditions will, of course, permit such bank loans to be refunded, but logic requires us to recognize that the improvement is prospective, whereas the bank loans themselves are very real and very menacing. When a company's earnings are substantial, it rarely becomes insolvent because of bank loans. But if refinancing is impracticable, as frequently it was in the 1931 to 1933 period, the lenders may require suspension of dividends in order to make all the profits available to reduce the debt. It is for this reason that the dividend on Brooklyn Manhattan Transit Corporation Common was passed in 1932, and the preferred dividend of New York Water Service Corporation was passed in 1931, although both companies were reporting earnings about as large as in previous years. The 1937 to 1938 recession did not create corporate financial problems comparable with those arising out of the two previous depressions. In this respect, there is a significant contrast between the stock markets of 1919 through 1921 and 1937 through 1938. For the decline in stock prices was actually greater, both in dollars and percentage-wise, in the recent period than in the post-war collapse, although intrinsically the 1937 to 1938 downturn was of much smaller importance, since it had relatively slight effect upon the position of American corporations generally. This may be taken as a rather disquieting sign that stock prices have been growing more irrationally sensitive to temporary fluctuations in business, a fact that we are inclined to ascribe to the disappearance of the old line distinctions between stock investors and stock speculators. Intercorporate indebtedness. Current debt to a parent or to an affiliated company is theoretically as serious as any other short-term liability, but in practice it is rarely made the basis of an embarrassing claim for payment. Example: United Gas Corporation has owed $26 million on open account to its parent electric bond and share company since 1930, so that it constantly reports a large excess of current liabilities over current assets. Yet this debt has not prevented it from paying first preferred dividends in 1936 to 1939. In 1932, however, with somewhat larger earnings than in 1939, it had been compelled to suspend the senior dividend because it had large bank loans in addition to its intercompany debt. The conservative buyer would naturally prefer to see the obligations to affiliates in some form other than a current liability. The danger of early maturing funded debt. A large bond issue coming due in a short time constitutes a critical financial problem when operating results are unfavorable. Investors and speculators should both give serious thought to such a situation when revealed by a balance sheet. Maturing funded debt is a frequent case of insolvency. Examples: Fisk Rubber Company was thrown into receivership by its inability to pay off an $8 million note issue at the end of 1930. The insolvency of Colorado Fuel and Iron Company and of the Chicago, Rock Island, and Pacific Railway Company in 1933 were both closely related to the fact that large bond issues fell due in 1934. The heedlessness of speculators is well shown by the price of $54 established for Colorado Fuel and Iron Preferred in June 1933, when its short-term bond issue, Colorado Industrial Company 5s due 1934, guaranteed by the parent company, was selling at 45, an indicated yield of well over 100% per annum. This price for the bonds was an almost certain sign of trouble ahead. Failure to meet the maturity would, in all likelihood, mean insolvency, for a voluntary extension could by no means be counted upon, and the danger of complete extinction of the stock issues. It was typical of the speculator to ignore so obvious a hazard, and typical also that he suffered a large loss for his carelessness. 2 months later, on announcement of the receivership, the price of the preferred stock dropped to 17 1/4. New York, Chicago, and St. Louis Railroad Company has been faced with a continuous financial problem growing out of the sale of a 3-year note issue in 1929. Since the first maturity in 1932, it was repeatedly extended under threat of receivership as an alternative. Typical of speculative disregard of financial problems was the advance of this company's preferred stock from 18 1/2 to 45 3/4 in 1939, against a low price that year of only 50 for the notes due in 1941. Even when the maturing debt can probably be taken care of in some way, the possible cost of the refinancing must be taken into account. Examples. This point is well illustrated by the $14 million issue of American Rolling Mill Company 4.5% notes due November 1, 1933. In June 1933, the notes were selling at 80, which meant an annual yield basis of about 75%. At the same time, the common stock had advanced from 3 to 24 and then represented a total valuation for the common stock of over $40 million. Speculators buying the stock because of improvement in the steel industry failed to consider the fact that, in order to refund the notes in the poor market then existing for new capital issues, a very attractive conversion privilege would have to be offered. This would necessarily react against the profit possibilities of the common stock. As it happened, a new 5% note issue, convertible into stock at 25, was offered in exchange for the 4.5% notes. The result was the establishment of a price of 101 for the notes in August 1933 against a coincident price of 21 for the common stock, and a price of 15 for the stock on November 1, 1933, when the notes were taken care of at par. The impending maturity of a bond issue is of importance to the holders of all the company's securities, including mortgage debt ranking ahead of the maturing issue. For even the prior bonds will, in all likelihood, be seriously affected if the company is unable to take care of the junior issue. This point is illustrated in striking fashion by the Fisk Rubber Company First Mortgage 8s due 1941. Although they were deemed to be superior in their position to the 5.5% unsecured notes, their holders suffered grievously from the receivership occasioned by the maturity of the 5.5s. The price of the 8s declined from $115 in 1929 to $16 in 1932. Bank loans of intermediate maturity. The combination of very low interest rates and the drying up of ordinary commercial bank loans has produced a new phenomenon in recent years: the loaning of money to corporations by banks, repayable over a period of several years. Most of this money has been borrowed for the purpose of retiring bond issues. For example, Commercial Investment Trust Corporation in November 1939, and even preferred stock. For example, Archer Daniels Midland Company in 1939. In some cases, such loans have been made for additional working capital. For example, Western Auto Supply Company in 1937, or to replace ordinary short-term bank credit. For example, American Commercial Alcohol, Stokely Brothers. In most cases, it is stipulated or expected that the loans will be retired in annual installments. From the standpoint of security analysis, this bank credit resembles the short-term notes that used to be sold to the public as a familiar part of corporate financing. It must be considered partly equivalent to current liabilities and partly to early maturing debt. It is not dangerous if either the current asset position is so strong that the loans could readily be taken care of as current liabilities, or the earning power is so large and dependable as to make refinancing a simple problem. As in the Stokely example referred to previously in this chapter, the analyst must view the presence of a substantial amount of intermediate bank debt as a potential threat to dividends or even to solvency. It should not be necessary to dilate further upon the prime necessity of examining the balance sheet for any possible adverse features in the nature of bank loans or other short-term debt. Comparison of balance sheets over a period of time. This important part of security analysis may be considered under three aspects, viz. 1. As a checkup on the reported earnings per share. 2. To determine the effect of losses or profits on the financial position of the company. 3. To trace the relationship between the company's resources and its earning power over a long period. Checkup on reported earnings per share via the balance sheet. Some of this technique has already been used in connection with related phases of security analysis. In Chapter 36, for instance, we gave an example of the first aspect in checking the reported earnings of American Commercial Alcohol Corporation for 1931 and 1932. As an example covering a larger stretch of years, we submit the following contrast between the average earnings of United States Industrial Alcohol Company for the 10 years 1929 through 1938, as shown by the reported per-share figures and as indicated by the changes in its net worth in the balance sheet. This may be found in the accompanying PDF. In addition to the foregoing, the company wrote down its fixed assets to $1 in 1933 by a charge of $19,301,000, of which $18,846,000 was taken out of capital account and the balance out of surplus. To the extent that depreciation charges since 1932 may have been insufficient because of this write-down, the reported earnings for the period were further overstated. The foregoing analysis does not require extended discussion, since most of the points involved were covered in chapters 31 to 36. Virtually all of the charges made to surplus between 1929 and 1938, except for the write-down of the plant account to $1, represented a real diminution of the reported earning power of United States Industrial Alcohol during this 10-year period. It seems likely also that the surplus would have shrunk considerably farther if the plant account had been carried at a proper figure and appropriate depreciation charged against it since 1932. The fact that the company's working capital decreased by $3,192,000 despite receipt of $6,582,000 from the sale of additional stock is further evidence that, instead of there being a surplus above dividends as reported, the company actually lost money before dividends during these 10 years. Checking the effect of losses or profits on the financial position of the company. An example of the second aspect was given in Chapter 43 in the comparison of the 1929 to 1932 balance sheets of Manhattan Shirt Company and Hupp Motor Car Corporation, respectively. A similar comparison is shown below, which may be found in the accompanying PDF, covering the exhibit of Plymouth Cordage Company and H.R. Mallinson and Company during the same period, 1929 to 1932. Despite the large reduction in the surplus of Plymouth Cordage during these years, its financial position was even stronger at the end of the period than at the beginning, and the liquidating value per share, as distinct from book value, was probably somewhat higher. On the other hand, the losses of Mallinson almost denuded it of working capital and thereby created an extremely serious obstacle to a restoration of its former earning power. Taking losses on inventories may strengthen financial position. It is obvious that losses that are represented solely by a decline in the inventory account are not so serious as those which must be financed by an increase in current liabilities. If the shrinkage in the inventory exceeds the losses, so that there is an actual increase in cash or reduction in payables, it may then be proper to say, somewhat paradoxically, that the company's financial position has been strengthened, even though it has been suffering losses. This reasoning has a concrete application in analyzing issues selling at less than liquidating value. It will be recalled that, in estimating breakup value, inventories are ordinarily taken at about 50 to 75% of the balance sheet figure, even though the latter is based on the lower of cost or market. The result is that what appears as an operating loss in the company's statement may have the actual effect of a profit from the standpoint of the investor who has valued the inventory in his own mind at considerably less than the book figure. This idea is concretely illustrated in the Manhattan Shirt Company example mentioned previously in this chapter. If we consider only the company's figures, there was evidently a loss for the period with a consequent shrinkage in the value of the common stock. But if an investor had bought the stock, say at $8 per share in 1930, the low price in that year was 6 1/8, he would more logically have appraised the stock in his own mind on the basis of its liquidating value rather than its book value. From his point of view, therefore, the intrinsic value of his holdings would have increased during the Depression period from $12.50 to $14.75 per share, even after deducting the substantial dividends paid. What really happened was that Manhattan Shirt turned the larger portion of its assets into cash during these 3 years and sustained a much smaller loss in so doing than a conservative buyer of the stock would have anticipated. This accomplishment can be summarized in the table that may be found in the accompanying PDF. We have here a direct contrast between the superficial indications of the income account and the truer story told by the successive balance sheets. Situations of this kind justify our repeated assertion that income account analysis must be supplemented and confirmed by balance sheet analysis. Is shrinkage in value of normal inventory an operating loss? A further question may be raised with respect to changes in the inventory account. That is, whether or not a mere reduction in the carrying price should be regarded as creating an operating loss. In the case of Plymouth Cordage, we note the following comparative figures. Inventory, September 30th, 1929, $8,059,000. Inventory, September 30th, 1932, $3,150,000. Decrease 60%. In the meantime, the price of fibers had declined more than 50%, and there was good reason to believe that the actual number of pounds of fiber, rope, and twine contained in the company's inventory was not very much smaller in 1932 than in 1929. At least half of the decline in the inventory account was therefore due solely to the fall in unit prices. Did this portion of the shrinkage in inventory values constitute an operating loss? Could it not be argued that its fixed assets had suffered a similar reduction in their appraisal value, and that there was as much reason to charge this shrinkage against earnings as to charge the shrinkage in the carrying price of a certain physical amount of inventory? We have already discussed this point in our exposition of the normal stock basis of inventory valuation in Chapter 32, a method adopted by Plymouth Cordage itself after 1932. In theory, the analyst might attempt to put all companies on a normal stock basis for the purpose of calculating their earning power exclusive of inventory fluctuations and for uniform comparisons. Actually, he has not the data necessary for such calculations. Hence, he is reduced, here as in many fields of analysis, to the necessity of making general rather than exact allowance for the distorting effect of inventory price changes. Profits from inventory inflation. That the importance of inventory price changes is not confined to a depression period is emphatically shown by the events of 1919 and 1920. In 1919, the profits of industrial companies were very large. In 1920, the reported earnings were irregular, but in the aggregate quite substantial. Yet the gains shown in these 2 years were in many cases the result of an inventory inflation, that is, a huge and speculative advance in commodity prices. Not only was the authenticity of these profits thereby made open to question, but the situation was replete with danger because of the large bank loans contracted to finance these overvalued inventories. Examples. The following tabulation, found in the accompanying PDF, which covers a number of the leading industrial companies, will bring out the significant contrast between the apparently satisfactory earnings developments and the undoubtedly disquieting balance sheet developments between the end of 1918 and the end of 1920. The companies included in the foregoing computation were American Can, American Smelting and Refining, American Woolen, Baldwin Locomotive Works, Central Leather, Corn Products Refining, General Electric, B.F. Goodrich, Lackawanna Steel, Republic Iron and Steel, Studebaker, United States Rubber. We append also the individual figures for United States Rubber in order to add concreteness to our illustration. The United States Rubber figures for 1919 to 1920 present the complete reverse of Manhattan Shirts exhibit for 1930 to 1932. In the rubber example, we have large earnings but a coincident deterioration of the financial position due to heavy expenditures on plant and a dangerous expansion of inventory. The stock buyer would have been led astray completely had he confined his attention solely to United States Rubber's reported earnings of nearly $20 per share in 1920, and conversely, the securities markets were equally mistaken in considering only the losses reported during 1930 to 1932, without reference to the favorable changes occurring at the same time in the balance sheet position of many companies. It will be noted from our discussion here and in Chapter 32 that the matter of inventory profits or losses belongs almost equally in the field of income account and balance sheet analysis. Long-range study of earning power and resources. The third aspect of the comparison of successive balance sheets is of restricted interest because it comes into play only in an exhaustive study of a company's record and inherent characteristics. The purpose of this kind of analysis may best be conveyed by means of the following applications to the long-term exhibits of United States Steel Corporation and Corn Products Refining Company. 1. United States Steel Corporation, Analysis of Operating Results and Financial Changes by Decades 1903 to 1932. Analysis was made in 1933. The balance sheets are adjusted to exclude an intangible item, water, amounting to $508 million, originally added to the fixed property account. This was subsequently written off between 1902 and 1929 by means of an annual sinking fund charge, aggregating $182 million, and by special appropriations from surplus. The sinking fund charges in question are also eliminated from the income account. Refer to the tables found in the accompanying PDF. The significance of the foregoing figures. The 3 decades had, superficially at least, a somewhat equal distribution of good years and bad. In the first decade, 1904 and 1908 were depression years, while 1911 and 1912 were subnormal. The second period had 3 bad years, viz., 1914, 1921, and 1922, the last due to high costs rather than to small volume. The third decade was made up of 8 years of prosperity followed by 2 of unprecedented depression. The figures show that the war period, which occurred in the middle decade, was a windfall for United States Steel and added more than $300 million to profits as compared with the rate established in the first 10 years. On the other hand, the last 10 years were marked by a drastic falling off in the rate of earnings on the invested capital. The difference between the 5.2% actually earned and the 8% that might be regarded as a satisfactory annual average amounted to close to $600 million for the 10-year period. Viewing the picture from another angle, we note that in the 30 years the actual investment in United States Steel Corporation was more than doubled and its productive capacity was increased threefold. Yet the average annual production was only 27% higher, and the average annual earnings before interest charges were only 12% higher in 1923 to 1932 than in 1903 to 1912. This analysis would serve to raise the question, 1, if, since the end of the war, steel production has been transformed from a reasonably prosperous into a relatively unprofitable industry, And 2, if this transformation is due in good part to excessive reinvestment of earnings in additional plant, thus creating a condition of overcapacity with resultant reduction in the margin of profit. Postscript. The soundness of the foregoing analysis made in 1933 may be judged by developments since then. It should be pointed out that both the plant account figures and the annual earnings should be adjusted downward in the light of the later disclosures, viz. 1. Segregation from plant account in 1937 of $269 million and write-off of this amount in 1938, representing intangible assets at organization in addition to the $508 million written off to 1929. 2. A charge to surplus of $270 million in 1935 for additional amortization of fixed assets, presumably applicable to the entire preceding period. These later revisions, however, do not affect in any essential degree the conclusions drawn above. The showing of United States Steel in the years since 1932 would appear to bear out the pessimistic implications of the 1933 study. During the 6 years, 1934 to 1939, which in most instances supply a fair test period for judging normal earning power, Steel Common earned an average of but 14 cents per share. New developments in products, processes, or other factors, including war profits, may change the picture for the better, but this has become a matter for speculative anticipation of future improvement rather than a reasonable expectation based on past performance. Comment on the Corn Products Refining Company exhibit. The early period was one of subnormal earnings, which would have been still poorer if more nearly adequate depreciation charges had been made. As in the case of United States Steel, the war period brought enormous earnings to corn products. The decade 1916 to 1925 was marked as a whole by a great increase in working capital and a substantial reduction in funded debt and preferred stock. Depreciation charges exceeded expenditures on new plant. In the 1926 to 1935 period, we note a striking divergence from the exhibit of United States Steel for 1923 to 1932. Despite inclusion of the Depression years, Corn Products was almost able to increase its earning power proportionately with its enlarged capital investment. Its annual profits, both before and after depreciation, were about 4 times as large in this decade as in the period ending in 1915. If we use the same years for comparison, we shall find that United States Steel actually earned less in 1926 to 1935 than in 1906 to 1915. The balance sheet changes were marked by a further substantial shrinkage in the property account due to the liberal depreciation charged, but by a larger increase in the investment in affiliated companies, indicating a broad expansion of the company's activities. It is clear that the record of Corn Products Refining Company does not suggest the same questions or doubts as arise from an examination of the United States Steel Corporation's exhibit. Part 7. Additional Aspects of Security Analysis. Discrepancies between Price and Value. Introduction to Part 7. The Market is Still Not Efficient, by Nancy Zimmerman. Diving again into this classic work by Benjamin Graham and David Dodd brings me back in time to my adolescent encounter with Graham and Dodd's other major work, The Intelligent Investor. That book was my first exposure to the idea that investing begins with fundamental analysis. Somewhat later, I picked up security analysis and started to realize that investing might be something one could do professionally. Seth Klarman's invitation to join this 88-year-old book club prompts fond memories of those early impressions of Graham and Dodd. Rereading the clear prose and fine examples of Part 7 of Security Analysis reminds me of those moments when I first understood that the hard work of analysis, coupled with a patient and disciplined approach, could lead to an intellectually challenging and rewarding career. It also reminds me of the scores of investments I have made where Graham and Dodd's analytical precepts have continued to ring true. I share Benjamin Graham's view that good investing starts with a meticulous analysis of the security that you are proposing to go long or short. Sound investment analysis is forward-looking and involves both hard work and humility. Many decades after the publication of security analysis, the market still offers opportunities where the potential excess returns warrant the risks to which an investor's capital is exposed, what this book poetically terms a margin of safety. In the 1980s, during the summer after my sophomore year of college, I was offered a wonderful opportunity to learn more about markets and investing at O'Connor & Associates, an options trading firm in Chicago. An astute partner believed that mathematically inclined and curious students would make good colleagues and good market makers. The firm emphasized avoiding what Graham and Dodd would call market analysis and had a strong focus on a bottom-up effort to use mathematical techniques to price derivatives on single stocks, indices, bonds, and foreign exchange. O'Connor principals readily acknowledged that they did not know where the market was going. Rather, they felt that O'Connor could earn an attractive return on capital by making prices on the options of many stocks and indexes while laying off risk by trading options against each other, locking in pricing disparities. The market makers were encouraged to avoid any directional bets on individual stocks. The group responsible for assessing individual stock risk was a cerebral bunch who believed in reading as much as in mathematical modeling. At the top of their list, next to security analysis, was a biography of Jesse Livermore, a cautionary tale about speculation and leverage. When I was introduced to options markets at O'Connor that summer, a nascent, though increasingly complex world of indexes, index options, currency options, and U.S. Treasury bond options was beginning to take off. I developed an abiding conviction that there was no way to generate excess returns simply by doing market analysis, that is, placing trades based on particular market patterns. It was at that time I read what Graham and Dodd had written so many years earlier about technical analysis. Rereading these words again recently reinforced the folly of using historical prices to predict future prices. Nevertheless, these backward-looking approaches continue to generate substantial interest in the financial media as well as on Wall Street as each new crop of market participants arrives eager to beat the market. Graham and Dodd emphasized that outperformance is best pursued by looking on a bottom-up basis for individual securities that have a margin of safety relative to the risks entailed by the investment. One of the key observations of my career has been that this margin is most recognizable when comparing substantially similar securities. The enduring wisdom of Part 7 of security analysis is clear. Markets are not efficient, and the assiduous analyst can find opportunities, particularly in situations where very similar securities trade at different prices for the same risk, violating the financial theorem known as the law of one price, that identical securities, or baskets of securities, should have the same price across different markets. When I plowed through security analysis after my second summer at O'Connor, I was seized by the granular examples from an era gone by. I was worried that I'd simply been born just a little too late. While Graham and Dodd had been able to make profitable discoveries by looking bottom-up at companies, surely such opportunities did not persist in the modern world of finance. I was lucky to be wrong about this. In the next few decades, moving to Wall Street to understand the buy side, and then founding and running a firm focused on fixed income relative value opportunities, I would find that Graham and Dodd's taxonomy of the factors that create discrepancies between price and value is one of the world's greatest shopping lists. It offers many places to look for opportunities even in large, liquid, seemingly overfished markets. However, it often requires substantially more math and modeling work to understand when and how the same kinds of inefficiencies present themselves in our current, supposedly more sophisticated world. In Chapter 50, Discrepancies Between Price and Value, and Chapter 51, Discrepancies Between Price and Value Continued, Graham and Dodd review opportunities to profit from various aberrations in the securities market. Markets in the 1930s were certainly rife with price discrepancies, both those that were accessible to a professional investor with the ability to transact globally and those more obviously wrong but completely unhedgeable. Graham and Dodd describe some historical reasons for these discrepancies, including both asynchronous reporting of financial results and opaque dissemination of contractual details. Many decades have passed since their writing, yet amazingly, each category of price disparities remains alive and well today. Along the way, we have learned how to think about these discrepancies more systematically. One of the most fascinating developments in the last several decades is the integration of Graham and Dodd's ideas with modern finance. The themes that they sounded and the illustrations they provided have clear counterparts in today's financial economics, as well as in the practice of financial management and arbitrage. Graham and Dodd bring several broad ideas to life. First, the law of one price is often violated in financial markets. Identical or very similar assets trade at different prices in different markets, whether defined by currencies, exchanges, instruments used, or other domains of differentiation. Second, the sources of these deviations vary. Sometimes they occur because one market is dominated by a set of investors who are less involved in other markets. In fixed income markets, the reasons for the deviations from the law of one price often have to do with professional investment manager mandates and tendencies to track a benchmark. Some securities are included in indexes, for example, and as such become overpriced relative to very similar securities that are not part of those indexes. Some standardized securities are preferred by institutional investors relative to other more complicated instruments. Today, portfolios of securities can increasingly be replicated with better prospective returns by using portfolios of other securities and instruments that trade at a lower valuation for what are effectively the same expected returns. Third, in thinking about which securities are identical or very similar to each other, live data feeds, enormous computational power, and more sophisticated modeling of contingent claims have taken us much further than Graham and Dodd could have imagined. In their writing, they focused on the most likely scenarios, but now we have ways to imagine and model many scenarios beyond just the most likely ones. The forward march of technology has allowed us to build sophisticated models that were not available in the slide rule era. It has allowed us to aggregate these securities in portfolios and look at the cash flows alone or in combinations. It also allows us to stress test individual securities, capital structures, and even entire portfolios of securities. We can compare the distribution of outcomes implied by one security to those of another security. Moreover, we can price options using any distribution we can define. Fourth, we know that while prices of identical or nearly identical securities often eventually converge, they may take a long time to do so, and in fact, they may further diverge before they correct. Arbitrage, even of identical securities, is not riskless in the short run. It is wise to diversify one's holdings. The problem deepens when financial crises and other dislocations create unexpected and artificial correlations in the movements of unrelated securities. Leverage, including through the use of derivatives, can both magnify the problem or allow the manager to implement useful hedging arrangements. Even with perfect arbitrage, one can only make money on average, not always. Finally, at a somewhat broader level, Graham and Dodd's strategies point to the value of arbitrage strategies of the sort they envisioned for a long-term investor. That's because, at least in the medium term, the returns on these strategies are uncorrelated with those on other parts of the portfolio. As Graham and Dodd taught us, you cannot predict the movements of the market. For a sophisticated investor, this points to the benefit of having at least some part of the portfolio untethered from these movements. Some examples from modern times. Relative price dislocations between specific securities are the stuff that fixed income relative value strategies are made of. We have seen our share of them in recent decades. The art, as Graham and Dodd preach, is to keep looking for opportunities while not being hesitant to pass and await something more attractive. As their prominent disciple Warren Buffett said, "The trick in investing is just to sit there and watch pitch after pitch go by and wait for the right one in your sweet spot. And if people are yelling, 'Swing, you bum,' ignore them." An example of what Graham and Dodd discuss in the section titled Comparison of Definitely Related Issues occurred in late 2018 when investment-grade bonds dominated in euros traded systematically tight relative to dollar-denominated investment-grade bonds. This mispricing across currencies was largely caused by technical aspects of supply and demand, and secondarily by differences in the currency. The European Central Bank, ECB, exacerbated the cross-currency differential, particularly on securities from European issuers that were a part of a major ECB corporate sector buyback program intended to provide monetary policy accommodation and generally boost the euro area economy. As Graham and Dodd discuss in Discrepancies Due to Special Supply and Demand Factors, a large buyer can create significant dislocations between two pari passu bonds. Corporate bond market investors willing to look across both euro and U.S. dollar markets could be rewarded by taking advantage of significant discrepancies in the trading levels of bonds issued by the same company. For example, General Electric, which has had a global footprint through wide-ranging businesses for many years, is ultimately a U.S. issuer. Though bonds issued by GE, even those denominated in euros, were not included in the ECB buyback program, they were still swept tighter along with other euro-denominated bonds. GE senior notes denominated in U.S. dollars traded at a spread 100 basis points wider than GE senior notes denominated in euros, after accounting for the underlying currency and interest rate risk. Furthermore, the U.S. dollar-dominated issue was priced about 6 points lower. An alert investor would readily conclude that these GE bonds were definitely related, presenting the opportunity to invest in the undervalued U.S. dollar bond and sell the euro bond. Indeed, after only 2 months, the spread differential converged to 50 basis points and the price to within 1 point. The law of one price is continually disrupted. In the summer of 2022, for example, a 10-year vanilla U.S. dollar interest rate swap with identical terms traded at different rates in Chicago and in London. One of the trades from my earliest days in the markets that remains a source of opportunity is U.S. Treasury cash versus futures arbitrage. This type of basis trading involves a basket of U.S. Treasury bonds on a certain part of the curve hedged with a futures contract into which those bonds are deliverable. At any given time, one bond in the basket will be the cheapest to deliver into the futures contract, but relative price changes within the basket driven by changes in the shape of the yield curve or other idiosyncratic factors might make another bond the cheapest. When the futures contract is rich to the deliverable bond, a position that is short the futures contract and long the deliverable bond is poised to capture not only the pricing discrepancy, but also potential further gains should a different bond become cheapest to deliver. This trade also offers the optionality that it could be unwound before the delivery date if the relationship normalizes. It is particularly nice to put on a profitable trade with a definite expiration date, offering a clear catalyst on one side of the trade with the optionality of a more favorable outcome a distinct possibility. The business of the arbitrageur, or assiduous analyst in Graham and Dodd parlance, is to find which opportunities are genuine and which are illusory traps. Capital structures that are designed to last forever, like closed-end mutual funds, often divorce the economic interests of investors from control of decision-making. As a result, these can often be a trap, seemingly mispriced but with a discount that may never close. Graham and Dodd provide an excellent introduction to the costs and risks of investing through various investment structures. Chapter 47 discusses investment trust financing and lays out how cash fees, preferred stock, conversion privileges, and warrants create differing economics and incentives for deal promoters versus the investing public. As Graham and Dodd recount by carefully calculating the cost of management in these vehicles, Such permanent fee-paying arrangements that burden capital might look a lot like arbitrages when they trade at discounts to the value of the assets trapped in the structure, but they may turn out to be value traps. An example of this is the Grayscale Bitcoin Trust, GBTC, a passive trust that has allowed investors for a 2% annual fee to gain exposure to Bitcoin in the form of a security, avoiding the difficulties associated with buying and storing Bitcoin directly. GBTC remained a modest product for several years after launching in 2013, but as the price of Bitcoin and other cryptocurrencies soared in 2020, GBTC harnessed the greed of the crypto universe using a marketing pitch that the trust would durably trade at a premium to Bitcoin for economic reasons. Crypto investors were encouraged to buy Bitcoin, deposit it in the trust, and receive locked-up shares of GBTC that would become marketable in 6 months to harvest the premium. Once deposited, the assets became subject to a 2% annual fee in perpetuity. While this was appealing to some speculators in the heady days of Bitcoin, the value proposition was obviously not enduring, and as soon as the glow came off, the trust came under urgent selling pressure. By the summer of 2022, GBTC traded at a 30% discount to its net asset value. If one wished to try and capture this discount, there were very straightforward ways to get short Bitcoin with a creditworthy counterpart. Most notably, the future traded at the Chicago Mercantile Exchange. Would this be an opportunity? There might not be any near-term catalyst that forces a convergence, although optimists might focus on Grayscale's persistent campaign to persuade the U.S. Securities and Exchange Commission, SEC, to permit conversion of the trust into an ETF. In the absence of a catalyst, such as maturity or the ability to access the underlying Bitcoin and realize its value, this looks less like an opportunity for profit and more like a curiosity. Graham and Dodd would also point to the risk of possession of control by those who have no real capital investment. Thinking about which securities are nearly identical or very similar, with the benefit of modern finance and its probability state analysis, has turbocharged the ideas behind Graham and Dodd. In their writing, Graham and Dodd tend to focus on the most likely scenarios and then build in a margin of safety. Now we have ways to imagine and model many scenarios, not just the most likely ones. We have a much more sophisticated way of thinking about risks than was possible when Graham and Dodd presented their ideas, because we have both the models and the requisite computational power. We can even compare the various margins of safety or excess return per unit of risk. During the early days of my firm's efforts to extract market-neutral returns from fixed-income securities and derivative markets, there was a great deal of turmoil in the U.S. interest rate market. Short rates coming out of the very weak economic period of 1993 were less than 3%, and 5-year yields were around 5.2%. As the economy improved, more and more rate hikes were anticipated by the interest rate curve. In December 1994, the changes in the shape of the yield curve caused a serious disruption among over-leveraged market participants, including Mexico, Orange County, and many small banks. The de-risking of balance sheets and the unwinding of portfolios put pressure on rates. Interestingly, a steady stream of long volatility positions were also being unwound at the same time. This selling pressure left interest rate options trading at levels that implied that volatility would be well below where it had been historically. These depressed levels for options provided a ready hedge for any short volatility securities, for example mortgages, or a way to create an asymmetric profile of returns by taking a position against the extreme scenario priced into the market that the Fed would hike 200 basis points between Christmas and Easter in the middle of a meltdown. Modern analytical tools enabled both identification of the pricing discrepancy and the ability to calculate with greater certainty the possibility that the aberrational pricing would normalize. Graham and Dodd do a fine job of categorizing and analyzing the price dislocations between two similar assets in Comparison of Definitely Related Issues. An interesting and useful contemporary example of an arbitrage using related instruments involves trading corporate bonds versus credit default swaps, CDS, referencing the bond issuer, a common relative value strategy known as CDS basis trading. To pursue such a strategy, an investor can buy a cash bond together with insurance on that cash bond through a CDS contract with a creditworthy counterparty. Depending on the specific nature of the mispricing in question, one might expect their margin of safety, or alpha, to come from one or more types of cheapness. The spread over riskless rates on the bond exceeding the spread on the CDS, the bond trading at a lower price than the implied price of the CDS, which would be realized in an event of default, or perhaps from the cheapest to deliver option arising from the provision that any pari passu bond can be delivered in the event of default. Because of the tightness of the arbitrage and the inherent optionality, in the years from the dawn of the CDS market in the 1990s until the early market unraveling of 2007, which grew into the great financial crisis, we rarely observed basis packages of matched maturity bonds and CDS trading more than a few basis points cheap. The term of art for this cheapness is negative basis. But in the years leading up to and following the great financial crisis of 2008, we saw dramatic examples of how basis trades were impacted by the pressures on and behavior of many market participants. First, the negative basis exploded for a variety of reasons, attributable to holders of both the long cash instruments and the holders of negative basis packages. Then, when these participants became distressed, selling was conducted without regard for the economic status of the underlying company or asset, and there was insufficient arbitrage capital willing to take the other side of the trade to keep it tethered to value. The golden age of structured finance before the financial crisis created a seemingly endless supply of synthetic collateralized debt obligations, CDOs. The magic of structuring, or less charitably, the gaming of rating agencies, allowed CDO managers to sell highly rated tranches of CDS portfolios at spreads well below their component parts, generating selling pressure on CDS. This drove CDS spreads to extremely low levels, both on an absolute basis and compared to cash bonds. This was also an era of cheap financing. Some banks in Europe, as well as proprietary trading desks of U.S. banks, found an irresistible combination: negative basis opportunities with positive carry, higher bond coupon received than CDS running spread paid, and seemingly infinite funding at LIBOR flat, that is, without any spread over LIBOR, or better. Banks and proprietary trading desks put on negative basis trades in vast sizes, largely indiscriminately across corporate names, anytime their yield bogey was met. These trades also boosted the earnings of more than a few financial institutions because their accountants let them recognize the present value of this annuity over the lifetime of the package. They had found a money machine. But starting in late 2007, cheap financing disappeared and banks, let alone proprietary trading desks, could not rely on LIBOR flat financing or infinite balance sheets. This funding pressure alone would likely have caused cash bonds to underperform CDS, but the forced unwinding of large positions by highly levered institutions caused even more pressure and pushed the relationship even more negative. A number of institutions, unwilling to take the financing risk or the mark-to-market volatility on what had been a low-value, positive carry trade, simply closed out of their positions. Particularly painful were the basis packages where the underlying cash security lost its investment-grade rating, and holders had to de-book the profits at a particularly poor moment. The great financial crisis dramatically underscored the risk that banks and other financial participants take on when they pile substantial leverage on top of a small mispricing, one good idea coupled with an incredibly bad one. It also highlighted the importance of establishing sustainable financing arrangements and not being overly reliant on any financing that is not clearly contractually agreed at the outset of the trade. While the extreme negative basis spreads of 2008 and their immediate aftermath have not been revisited, the zero-ish bound has been relegated to the trash can, and negative basis packages with hundreds of basis points or even double-digit points continue to be seen in the wild. The folly of technical analysis. I was particularly pleased to reread Graham and Dodd's thoughts in Chapter 52 about technical analysis. Their wisdom about the futility of using past price movements to predict future market movements is a searing rebuttal to all backward-looking techniques that rely on the assumption that the future is easily gleaned by scrutinizing past price data. This extends from technical analysis to excessive reliance on historical regressions. Anyone considering handing their financial future over to any strategy based on the general idea that a study confined to past price movements can be availed of profitably to foretell the movements of the future should examine whether they can rebut Graham and Dodd's basic objections. The strategies they call into question include VAR-based risk modeling, which implicitly promises that the market will move in a predictable amount and exhibit stable correlations in the future. Consider Graham and Dodd's third conclusion on this topic in Chapter 52. The theoretical basis of chart reading runs somewhat as follows. A. The action of the market, or of a particular stock, reflects the activities and the attitude of those interested in it. B. Therefore, by studying the record of market action, we can tell what is going to happen next in the market. Graham and Dodd caution us that the premise may well be true, but the conclusion does not necessarily follow. Before going blindly into strategies that rely on historical patterns, one must have clear answers to the question of how might the technical position of any stock or position tell me anything more than about the behavior of the investors in that instrument. How is the behavior of the investors relevant to the instant situation? It is essential to tether this technical information to the fundamental properties of the issuer's business and the contractual relationships of the securities in question. Where do discrepancies come from? Identifying and exploiting discrepancies between price and value and striving to isolate whether there is a margin of safety that can deliver alpha is the central activity of market-neutral investing. Which disparities are worth pursuing and which are best left to be merely observed and learned from? It is helpful to follow Graham and Dodd's path and trace the forces causing the discrepancy between price and value. Perhaps the most significant of these factors over time has proven to be indexation. According to Bloomberg Intelligence, the market share of passive equity strategies overtook that of active strategies around August 2018 and was nearly 55% by 2021, driven largely by the growth of funds tracking the S&P 500 and other broad U.S. indexes. This shift has been accelerated by a variety of forces, including the advent of robo-advisors, the rising adoption of model portfolios by advisors, and the growth in advisors' use of passive ETFs and funds. Active managers still dominate in fixed income, although passive's share rose to 34% from 31% in the third quarter of 2021, following the worst bond returns in decades amid rising rates and capital outflows. Given the significant amount of closet indexing in fixed income markets, those percentages likely understate the true impact of index inclusion or exclusion on the universe of likely buyers, or forced sellers, for a given bond. When demand for a security is created by its mere inclusion on a list without regard to its fundamental value, the price will change in ways that are not related to fundamental developments. This brings us to the rating agencies, the organizations to whom passive market participants have outsourced the work that Graham and Dodd implored the assiduous analyst to undertake. The agencies have proven time and again to be backward-looking, belatedly downgrading in response to past performance. Their ratings also demonstrate positive serial correlation, so we know they do not move their ratings enough each time to get to a place where the new rating reflects all available information at that moment. This reality makes it clear that spreads should and do move much faster than ratings and invite participants to game downgrades in order to pick up spreads, creating additional inefficiencies. Many fixed income indexes rely on ratings as an inclusion factor, and several types of institutional investors are required by mandate or regulation to restrict themselves to bonds over a certain ratings threshold. Putting all these factors together, there is forced selling on downgrades by passive vehicles on the date of an index exclusion. This puts pressure on the price of the assets even when the information driving the downgrade has been fully processed. These well-documented inefficiencies lead to another set of dislocations where institutional investors try to predict behavior that is non-economic and the participant is worse off on a net present value basis. Another frequent culprit is the presence of non-economic or constrained economic agents in a market. Often, this takes the form of some sort of official sector intervention program with strictly defined criteria for inclusion. The ECB has employed many such programs, including the previously mentioned corporate sector buyback program and others targeting an array of asset types. The assets that are included frequently become displaced relative to otherwise similar assets outside the scope of such a program. Other times, it is a matter of habitat preference for certain investors. There are investors who either must for regulatory reasons or merely prefer to, for ease of operations, own bonds that are denominated in their own currency, traded in their home market, or issued in their own legal jurisdiction. Such investors will care little if bonds of the same issuer in other currencies trade significantly rich or cheap relative to the bonds they own. In times of market stress, many of these factors act in concert to amplify these dislocations. In the modern financial world, all of these kinds of forces are being exerted across many time zones and regulatory regimes, and there are obvious short circuits that can sever the market prices of instruments reflecting the same underlying risk. One might be able to observe the risk of a given company through its debt, its CDS, the cash and derivative indexes in which it is included, and tranches on those indexes. One might see different levels of implied risk for a country in its native interest rates, currency forwards, local debt, and external debt. An important part of modern security analysis is trying to figure out which of these factors are transitory and which are permanent. Are there catalysts that will cause the price to converge? How long will it take? How much capital will it use up? How does this dislocation compare to others happening at the same time? How is it correlated with those dislocations? Final thoughts. Graham and Dodd's enduring insight is that all good investment practice is based on doing detailed bottoms-up work. Investing requires thoroughly understanding the contractual relationships that govern a security and the real-life factors that are involved in enforcing contractual obligations should the need arise. All investment finance turns on accurately modeling the cash flows, determining an appropriate discount rate, and assessing the likelihood that you get them. The stark reality that markets are not efficient, and highly unlikely ever to be so, instructs us to focus our time and allocate our capital to those situations where we see the greatest dislocation between price and value. At the same time, we need to keep a clear eye on the unexpected, the real-life vicissitudes that turn potential opportunities into traps. We need catalysts to force prices to converge to value. While we are waiting for those catalysts, the capabilities and character of management are very important. Whether you are thinking of investing in uncorrelated arbitrages or buying the cheapest security of a quality company, Graham and Dodd's work exhorts us to read the documents, understand the structures, model the cash flows with precision, and, in a modern world, use our computational power to think probabilistically. Chapter 46. Stock Option Warrants. During the last 2 decades, the use of stock option warrants has passed through an extraordinary development. They were devised originally as a form of participating privilege for bonds and preferred stocks to which they were attached. In this form, they were commonly regarded only as a feature of the senior security, similar to a conversion right, and the warrants themselves had little significance in relation to the company's capitalization structure. Later, the idea was hit upon of creating stock option warrants separately from other securities and delivering them as compensation to underwriters, promoters, and executives. From this point, the inevitable next development was the issuance, through sale or exchange, of separate option warrants to the general public in the same manner as common stocks. They thus attained full stature as an independent form of security, as an important part of the financial setup of many corporations, and as a popular and prominent medium of speculative activity. In a previous chapter, we considered the technical aspects of option warrants as an adjunct of senior securities. In this chapter, we shall discuss the more important role of option warrants as a separate financial instrument. Our treatment falls into 3 sections. 1. Description. 2. Technical characteristics of warrants as a vehicle of speculation. 3. Their significance as a part of the financial structure. Descriptive summary. A detachable option warrant is a transferable right to buy stock originally running for a considerable period of time. Warrants attached to a debenture bond issue are sometimes called debenture bites. A third name for the same thing is stock purchase warrant. Its terms include 1. The kind of stock, 2. The amount, 3. The price, 4. The method of payment, 5. The duration of the privilege, and 6. Anti-dilution provisions. The last were described in Chapter 25. Kind of stock covered by the privilege. Nearly all option warrants call for common stock of the issuing company. In rare instances, they apply to preferred stock, for example, American Locker Company, Inc., or to stock of some other concern. For example, warrants attached to Central States Electric Corporation Preferred called for North American Company stock, and warrants attached to Solvay American Investment Corporation Preferred stock called for Allied Chemical and Dye Corporation stock. Warrants have no right to receive interest, dividends, or payments on account of principal, nor have they the right to cast any vote. Resemblance to subscription rights. Option warrants bear some resemblance to the subscription rights that are issued by corporations to their stockholders in connection with the sale of additional stock. There are 2 significant differences, however, between warrants and rights. Warrants run for a long period, and the stock purchase price is almost always set higher than the quotation at the time of their issuance. Moreover, the price is frequently varied in accordance with the terms of the warrant. Subscription rights run for a short time and call for a fixed price, usually under the market at the time of their authorization. Subscription rights are devised, therefore, with the intent of assuring their exercise and the prompt receipt of funds by the company. Option warrants generally have no relation to the financial needs of the company, and they are not expected to be exercised in short order. Stated in a different way, and referring to the usual situation at the time of issuance, a subscription right will be exercised unless the market declines substantially before they expire. Option warrants will not be exercised unless the market price advances substantially in the near or distant future. Subscription rights generally run for about 60 days. The original duration of option warrants is rarely, if ever, less than a year, and many of them are perpetual. Method of payment. Most option warrants require payment of the subscription price in cash. Those originally attached to bonds or preferred shares may permit payment either in cash or by tender of the senior security, which is accepted at its face value. This alternative may be of considerable practical importance. Example: electric power and light warrants are a perpetual call on common stock at $25 per share. Payment may be made either in cash or by tendering second preferred stock at $100 per share. In November 1939, the common stock sold at 8 and the second preferred at 17. Because of the very low price of the senior issue, the warrants had an exercisable value even though the common was selling 17 points below the option price. The calculation is as follows. 1 warrant plus 1/4 share of second preferred equals 1 share of common. Value of option warrant equals 8 minus 1/4 times 17 equals 3 3/4. Basis of trading in warrants. Option warrants are bought and sold in the market in the same way as common stocks. Up to the end of 1939, only 2 issues of warrants had been separately listed on the New York Stock Exchange, but many were actively dealt in on the New York Curb Exchange and other exchanges. The basis of trading in these instruments is somewhat eccentric and at times conducive to serious error. Under the standard rule, 1 warrant means the right to buy 1 share of stock and not the right originally attached to 1 share of stock. Examples. Walgreens Drug Company preferred stock was sold with warrants entitling the holder to buy 2 shares of common for each preferred share. Under the regular rule of trading, 1 Walgreens warrant meant the right to buy 1 share of common. That is, each share of preferred was said to carry 2 warrants. Similarly, Consolidated Cigar Corporation's 6.5% preferred stock was issued with a warrant attached to each share calling for the purchase of 1/2 share of common. These warrants were also traded in on the basis that 1 warrant was the right to buy 1 share of common. That is, each share of 6.5% preferred was said to carry half a warrant. But the exceptions to this standard rule are numerous. Examples. Commercial Investment Trust Corporation 6.5% preferred carried warrants to buy 1/2 share of common for each share of preferred, the same ratio as in the case of Consolidated Cigar Preferred. But the unit of trading on the New York Stock Exchange was the warrant originally attached to 1 share of preferred. That is, it called for half a share of common. Similar departures were made in the rules of trading for Niagara Hudson Power Corporation, B warrants, Lowe's, Inc., preferred warrants, Safeway Stores, Inc., old series warrants, etc. When a change is made in the number of shares called for by the warrant, the customary procedure is to continue to trade in 1 old warrant as 1 warrant. Example. 1 Lowe's bond warrant originally called for 1 share of common at $55. It represented the warrant attached to $200 of Lowe's 6% debentures due 1941. When a 25% stock dividend was paid in 1928, the anti-dilution provision required that an additional quarter share be given free with each share subscribed for under the warrant. 1 Lowe's bond warrant remained physically unchanged and thereafter represented the right to purchase 1 1/4 shares for $55. Similarly, in the case of Commercial Investment Trust warrants, when the common stock was split 2.5 for 1. 1 warrant thereafter represented the right to buy 1 1/4 new shares instead of 1/2 an old share. But the opposite practice is sometimes followed. Example, Niagara Hudson Power A warrants. These called for 1 share of common at $35. The company recapitalized in 1932 and issued 1 new share for 3 old. Hence, what was formerly 1 warrant now called for 1/3 of a new share for $35. That is, at $105 per share. The New York Curb Exchange thereupon redefined 1A warrant as representing the right to buy 1 new share. Hence, 3 old warrants became 1 new warrant. These technical details are given here because they are not available in standard descriptive textbooks. Those buying or selling a particular option warrant are cautioned to make careful inquiry into the basis of trading therein. Examples of warrants issued for various purposes. A. Attached to senior securities. Perhaps the earliest instance is the issue of American Power and Light notes in 1911. By far the most prominent is the sale by American and Foreign Power Company of $270 million of second preferred stock carrying warrants for no less than 7,100,000 shares of common. B. As compensation to underwriters. The first important case seems to have been the $25 million Barnsdall Corporation 6% bond issue of 1926. Here, the bankers received, as part of their compensation, warrants for 500,000 shares of common. At the subsequent high price, these warrants would have been worth $13 million. National Fund, Inc., an open-end investment trust, issued warrants to the sponsors in 1936 in lieu of the customary loading charge. Many flotations of smaller companies now include large amounts of warrants in addition to cash compensation for bankers. Examples: Aeronautical Corporation of America, 1939; Triumph Explosives, Inc., 1939; Howard Aircraft Corporation, 1939. C. As compensation to promoters and management. A striking case was the formation of Petroleum Corporation of America in January 1929. The public was offered 3,250,000 shares of stock at $34 per share. 5-year warrants to buy 1,625,000 shares at $34 were issued to the promoters and management. D. Issued in a merger or reorganization plan in exchange for other securities. Commonwealth and Southern Corporation issued about 17,500,000 warrants, together with 34 million shares of common and 1,500,000 shares of preferred, mainly in exchange for securities of 6 constituent companies. It is interesting to note that it issued common stock and warrants in exchange for Penn Ohio Edison Company and Southeastern Power and Light Company option warrants. In the 1937 reorganization of Baldwin Locomotive Works, the old preferred and common were both exchanged for new common and warrants. In the Colorado Fuel and Iron reorganization of 1936, only warrants were given for the old preferred and common. The reorganization plan for Erie Railroad, presented in 1938 in behalf of insurance companies holding bonds, was unique in that it gave old stockholders warrants to buy new common from the old creditors instead of from the company. E. Attached to an original issue of common stock. Public Utility Holding Corporation of America sold 2,500,000 shares of common stock, carrying warrants to buy an equal number of shares of additional common. In addition, the organizing interests purchased 500,000 shares of Class A stock with voting control, together with warrants to buy 1 million shares of either Class A or common stock. F. Sold separately for cash. In 1929, Fourth National Investors Corporation sold to its parent company 750,000 option warrants for $3 million. In 1936, Phillips Packing Company sold warrants to bankers for cash. Warrants as a vehicle of speculation. In a broad sense, option warrants possess the same general characteristics as low-priced common stocks, the theory of which was discussed in Chapter 41. Warrants are in name and in form, as low-priced stocks frequently are in essence, a long-term call upon the future of a business. It is true also that the relationship between a warrant and its common stock is roughly similar to that between a common stock and a speculative senior security of the same company. The qualitative element. As with all other speculative commitments, the attractiveness of a given warrant depends upon 2 entirely dissimilar factors: the qualitative element being the nature of the enterprise in relation particularly to its supposed chance of great improvement, and the quantitative element being the terms on which the warrant is offered, including its price and the price of the common stock it calls for. Security analysis cannot be counted upon to reveal those businesses which are most likely to forge ahead in the years to come. There is not much we can say, therefore, about the qualitative element in selecting warrants for speculation. Since ordinarily a warrant can attain tangible value only through an increase in earnings, emphasis must be laid upon the prospects of change rather than upon stability. Public utility warrants, for example, became extremely popular in 1928 to 1929, not because of the superior stability of utility enterprises, but because the market was convinced that their earnings would continue to expand indefinitely. As far as the arithmetical chance of a large price advance is concerned, we have already shown that this is most likely to be found in the common stock of speculatively capitalized enterprises. For example, A.E. Staley Company and American Water Works and Electric, discussed in Chapter 40. Hence, warrants to buy common stocks of this kind may also be said to have a special speculative advantage. But this is, at bottom, a quantitative rather than a qualitative matter. In our view, it is rarely possible to say with assurance that the long-term prospects of a particular line of business are so much better than the average as to make warrants connected with that field more attractive than any others. But if the individual speculator has definite opinions and preferences on this score, it is perfectly logical for him to follow them. Quantitative considerations. Importance of low price. It is an easier matter to point out the elements that govern the relative attractiveness of warrants from a quantitative standpoint. The desirable qualities are, first, a low price, second, a long duration, and thirdly, an option or purchase price close to the market. From the standpoint of speculative theory, the most important of the three, no doubt, is a low price for the warrant. This may be brought out by a comparison of the situation existing in the Sinclair Oil and Refining Corporation warrants in 1917 and Niagara Hudson Power Corporation B warrants in 1929. Examples. The warrant attached to each $1,000 Sinclair Oil and Refining Corporation note issued in 1917 entitled the holder to buy 25 shares of stock at $45 per share until August 1, 1918, at $47.50 until August 1, 1919, and at $50 until February 1, 1920. In December 1917, the stock had declined to $25.25, and a warrant for 25 shares could be bought at $20, that is, at a cost of only 80 cents per share. Here, the market price of the stock was far below the option price, but the option could be acquired at a very low cost per share. The sequel was quite characteristic of speculative markets. In less than 18 months, Sinclair oil stock rose to 69.75, giving a warrant for 25 shares a realizable value of over $550. An increase of 175% in the price of the stock produced an increase of 2,680% in the price of the warrant. The Niagara Hudson Power Corporation B warrants entitled the holder to buy 3.5 shares of common for $50, that is, at $14.28.50 per share. When the warrants were admitted to trading on the New York curb in 1929, they sold at $60, equivalent to $17 for a 1-share warrant, while the stock was selling at $22.50. In this case, the speculator was paying nearly as much per share for the warrants as for the stock. When the latter advanced to its high of 31 later in the year, the warrants rose by a much smaller percentage to 21. Still later in the same year, the price of the stock broke to 11 1/4, and then the warrants collapsed to a low of 2. These comparative figures show that at the equivalent of 17, the Niagara Hudson B warrants were selling at an extraordinarily unattractive price. Low relative price important. It is technically desirable that the price of a warrant be low not only in itself, but also in relation to the price of the common stock. This point may be shown by a comparison of Commercial Investment Trust Corporation warrants in 1928 with American and Foreign Power Company warrants in 1933. Examples. Commercial Investment Trust Corporation warrants sold at $6 each in August 1928. They entitled the holder to buy 1/2 share of common at $90 per share until the end of 1929, and at 100 thereafter until January 1st, 1931. The common was then selling at about 70. The warrant for one share thus represented a commitment of $12, or about 1/6 the current value of the stock. Despite the relatively high purchase price specified in the warrant, the latter might be considered as having a speculative advantage over the stock because of the much smaller money cost involved. As it happened, the price of the warrants advanced 11-fold in 1928 to 1929, as against a 3-fold rise in the common. In November 1933, warrants for one share of American and foreign power could be bought at 7, representing exact parity with the common. But the fact that the common was itself selling at only 10 removed any special speculative advantage from the warrants at 7. As we shall see later, it throws the stock and the warrants together into the category of pseudo-low-priced speculations, of the kind discussed at the beginning of Chapter 61. The foregoing discussion leads to the conclusion that a given option warrant has speculative attractiveness in a technical sense only if it constitutes a low-cost, long-term right to purchase a stock at a price not too remote from the current market. Examples: the Sinclair Oil and Commercial Investment Trust warrants referred to above are examples that met these requirements. An unusual example is furnished by the Barnsdall Oil warrants in 1927. These were a call on the stock at 25. When the shares were selling at 31, the warrants sold at 6, exactly at parity. In this case, any rise in the value of the stock would have meant, and later did mean, a much larger proportionate rise in the price of the warrants. Technical advantages often absent. During 1928 to 1929, when trading in warrants was most active, there was a tendency for these instruments to sell at high levels, both relatively and absolutely, so that they could not be said to possess any technical advantage over the typical common stock. During the ensuing depression, many warrant issues were obtainable at very low prices, but here again, the related common shares were also quoted so low as to call into question the comparative attractiveness of the warrant. The situation at the close of 1939 may be illustrated by the representative list of warrants that may be found in the accompanying PDF. It is to be noted that the warrants carrying the right to make payment by turning in a bond or preferred issue at par were generally selling at an interesting price in relation to the common stock. The electric power and light warrants were actually quoted below parity. The other low-priced warrants seemed too far away from realizable value to merit attention. The Baldwin locomotive and New York City omnibus price relationships are typical of their respective stages in the scale of market values. Warrants as part of the capitalization structure. Option warrants are essentially a device to give separate embodiment to the element of future prospects, but the right to benefit from future improvement or enhancement belongs inherently to the common stockholder. It is one of the important considerations that he receives in return for putting up his money and taking the first risk of loss. The basic fact about an option warrant, therefore, is that it represents something that has been taken away from the common stock. The equation is a simple one. Value of common stock plus value of warrants equals value of common stock alone. That is, if there were no warrants. Warrants represent a subtraction from the related stock. Example: this point may be illustrated concretely by reference to the effect of the issuance of the Barnsdall warrants upon the value of the stock. The earnings reported for 1926 were $6,077,000, or $5.34 per share on 1,140,000 shares outstanding. However, there were also in existence warrants to buy 1 million shares at $25. The proceeds to be applied to retire $25 million of 6% bonds. The analyst should have assumed exercise of the warrants, thus reducing the 1926 earnings from $5.34 to $3.54 per share. In 1929, the warrants having actually been exercised, The earnings were $3.25 per share, as against $4.76 if there had been no warrants created. The average price of $35 for the year was equivalent to a value of $10 for the warrants. This meant substantially that about $8 per share had been taken away from the value of the common stock, which otherwise would have been worth $43 by the creation of the warrants. This illustration shows clearly that the effect of the creation of warrants is to diminish the benefits realized by the common from a large increase in the earnings or in the value of the business. Warrants to buy stock, even at a price above the market, therefore detract from the present value of the common stock, because part of this present value is based upon the right to benefit from future improvement. A dangerous device for diluting stock values. The option warrant is a fundamentally dangerous and objectionable device because it affects an indirect and usually unrecognized dilution of common stock values. The stockholders view the issuance of warrants with indifference, failing to realize that part of their equity in the future is being taken from them. The stock market, with its usual heedlessness, applies the same basis of valuation to common shares whether warrants are outstanding or not. Hence, warrants may be availed of to pay unreasonable bonuses to promoters or other insiders without fear of comprehension and criticism by the rank and file of stockholders. Furthermore, the warrant device facilitates the establishment of an artificially high aggregate market valuation for a company's securities because, with a little manipulation, large values can be established for a huge issue of warrants without reducing the quotation of the common shares. Stock option warrants have proved a convenient and appealing instrument in corporate reorganizations because they have enabled the reorganizers to give the old stockholders a sop of some kind while ostensibly turning the company over entirely to the creditors. The SEC, however, has taken a stand against this practice, contending that if the old stockholders really have no equity, they are not even entitled to warrants. A reductio ad absurdum. The public's failure to comprehend that all the value of option warrants is derived at the expense of the common stock has led to a practice that would be ridiculous if it were not so mischievous. We refer to the original sale of common stock carrying warrants to buy additional common stock. This arrangement gives nothing to the stockholders that they would not have had without the warrant, and it violates an obvious rule of sound corporate financing. A properly managed business sells additional stock only when new capital is needed, and in that event the stockholders are usually entitled to subscribe pro rata to the offering. To give subscription rights to stockholders when the money is not needed is nonsensical from all viewpoints except that of deceiving people into believing that something attractive is being offered them. It resembles the practice, sometimes indulged in, of declaring dividends in scrip, which is redeemable at the pleasure of the directors. This scrip is an unnecessary expression in separate form of a right that the common stock possesses inherently, viz., to receive future dividends when the directors see fit to pay them. Similarly, these option warrants attached to original issues of common stock are a superfluous expression of the stockholder's inherent right to participate in future stock offerings. A further study of the unwholesome implications of the warrant device is integrated with two broader lines of inquiry into financial practices. The first relating to the price paid by the public for the financing and management of business. The second relating to that group of manipulative and dangerous corporate practices referred to as pyramiding. These aspects of security analysis will be considered in the ensuing chapters. Chapter 47. Cost of Financing and Management. Let us consider in more detail the organization and financing of Petroleum Corporation of America mentioned in the last chapter. This was a large investment company formed for the purpose of specializing in securities of enterprises in the oil industry. The public was offered 3,250,000 shares of capital stock at $34 per share. The company received, therefore, a net amount of $31 per share, or $100,750,000 in cash. It issued to unnamed recipients, presumably promoters, investment bankers, and the management, warrants good for 5 years to buy 1,625,000 shares of additional stock, also at $34 per share. This example is representative of the investment trust financing of the period. Moreover, as we shall see, the technique on this score that developed in boom years was carried over through the ensuing depression, and it threatened to be accepted as the standard practice for stock financing of all kinds of enterprises. But there is good reason to ask the real meaning of a setup of this kind. First, with respect to what the buyer of the stock gets for his money, and second, with respect to the position occupied by the investment banking houses floating these issues. Cost of management, 3 items. A new investment trust, such as Petroleum Corporation in January 1929, starts with 2 assets, cash and management. Buyers of the stock at $34 per share were asked to pay for the management in 3 ways, viz. 1. By the difference between what the stock cost them and the amount received by the corporation. It is true that this difference of $3 per share was paid not to the management, but to those underwriting and selling the shares. But from the standpoint of the stock buyer, the only justification for paying more for the stock than the initial cash behind it would lie in his belief that the management was worth the difference. 2. By the value of the option warrants issued to the organizing interests. These warrants, in essence, entitle the owners to receive 1/3 of whatever appreciation might take place in the value of the enterprise over the next 5 years. From the 1929 viewpoint, a 5-year period gave ample opportunity to participate in the future success of the business. This block of warrants had a real value, and that value in turn was taken out of the initial value of the common stock. The price relationships usually obtaining between stock and warrants suggest that the 1,625,000 warrants would take about 1/6 of the value away from the common stock. On this basis, 1/6 of the $1,750,000 cash originally received by the company would be applicable to the warrants and 5/6 to the stock. 3. By the salaries that the officers were to receive, and also by the extra taxes incurred through the use of the corporate form. Summarizing the foregoing analysis, we find that buyers of Petroleum Corporation shares were paying the following price for the managerial skill to be applied to the investment of their money. 1. Cost of financing, $3 per share, $9,750,000. 2. Value of warrants, 1/6 of remaining cash, about $16,790,000. 3. Future deductions for managerial salaries, etc., unknown. Total $26,540,000 plus. The 3 items together may be said to absorb between 25 and 30% of the amount contributed by the public to the enterprise. By this we mean not merely a deduction of that percentage of future profits, but an actual sacrifice of invested principal in return for management. What was received for the price paid? Carrying the study a step farther, let us ask what kind of managerial skill this enterprise was to enjoy. The board of directors consisted of many men prominent in finance, and their judgment on investments was considered well worth having. But 2 serious limitations on the value of this judgment must here be noted. The first is that the directors were not obligated to devote themselves exclusively or even preponderantly to this enterprise. They were permitted, and seemingly intended, to multiply these activities indefinitely. Common sense would suggest that the value of their expert judgment to Petroleum Corporation would be greatly diminished by the fact that so many other claims were being made upon it at the same time. A more obvious limitation appears from the corporation's projected activities. It proposed to devote itself to investments in a single field, petroleum. The scope for judgment and analysis was thereby greatly circumscribed. As it turned out, the funds were largely concentrated first in two related companies, Prairie Pipeline Company and Prairie Oil and Gas Company, and then in a single successor enterprise, Consolidated Oil Corporation. Thus, Petroleum Corporation took on the complexion of a holding company in which the exercise of managerial skill appears to be reduced to a minimum once the original acquisitions are made. We are forced to conclude that financial schemes of the kind illustrated by Petroleum Corporation of America are unsatisfactory from the standpoint of the stock buyer. This is true not only because the total cost to him for management is excessive in relation to the value of the services rendered, but also because the cost is not clearly disclosed, being concealed in good measure by the use of the warrant artifice. The foregoing reasoning does not rest in any way upon the fact that Petroleum Corporation's investments proved unprofitable. Position of investment banking firms in this connection. The second line of inquiry suggested by this example is also of major importance. What is the position occupied by the investment banking firms floating an issue, such as Petroleum Corporation of America, and how does this compare with the practice of former years? Prior to the late 1920s, the sale of stock to the public by reputable houses of issue was governed by the following three important principles. 1. The enterprise must be well established and offer a record and financial exhibit adequate to justify the purchase of the shares at the issue price. 2. The investment banker must act primarily as the representative of the buyers of the stock, and he must deal at arm's length with the company's management. His duty includes protecting his clients against the payment of excessive compensation to the officers or any other policies inimical to the stockholders' interest. 3. The compensation taken by the investment banker must be reasonable. It represents a fee paid by the corporation for the service of raising capital. These rules of conduct afforded a clear line of demarcation between responsible and disreputable stock financing. It was an established Wall Street maxim that capital for new enterprise must be raised from private sources. These private interests would be in a position to make their own investigation, work out their own deal, and keep in close touch with the enterprise, all of which safeguards, in addition to the chance to make a large profit, were considered necessary to justify a commitment in any new venture. Hence, the public sale of securities in a new enterprise was confined almost exclusively to blue sky promoters and small houses of questionable standing. The great majority of such flotations were either downright swindles or closely equivalent thereto by reason of the unconscionable financing charges taken out of the price paid by the public. Investment trust financing, by its very nature, was compelled to contravene these three established criteria of reputable stock flotations. The investment trusts were new enterprises. Their management and their bankers were generally identical. The compensation for financing and management had to be determined solely by the recipients, without accepted standards of reasonableness to control them. In the absence of such standards, and in the absence also of the invaluable arm's-length bargaining between corporation and banker, it was scarcely to be hoped that the interests of the security buyer would be adequately protected. Allowance must be made besides for the generally distorted and egotistical views prevalent in the financial world during 1928 and 1929. Developments since 1929. For a time it appeared that the demoralizing influence of investment trust financing was likely to spread to the entire field of common stock flotations, and that even the leading banking houses were prepared to sell shares of new or virtually new commercial enterprises without past records and on the basis entirely of their expected future earnings. There were definite signs of this tendency in the beer and liquor stock flotations of 1933. Fortunately, a reversal of sentiment has since taken place, and we find that the relatively few common stock issues sponsored by the first-line houses are now similar in character and arrangements to those of former days. However, there has been a fair amount of activity in the common stock flotation field since 1933, carried on by houses of secondary size or standing. Most of these issues represent shares of new enterprises, which in turn tend to fall in whatever industrial group is easiest to exploit at the time. Thus, in 1933, we had many gold, liquor, and beer stock flotations, and in 1938 to 1939, there was a deluge of airplane issues. The formation of new investment companies, on the other hand, appears to be a perennial industry. In surveying such common stock flotations, the starting point must be the realization that the investment banker behind them is not acting primarily in behalf of his clients who buy the issue. For on the one side, the new corporation is not an independent entity which can negotiate at arm's length with various bankers representing clients with money to invest, and on the other side, the banker is himself in part a promoter, in part a proprietor of the new business. In an important sense, he is raising funds from the public for himself. New role of such investment bankers. More exactly stated, the investment banker who floats such issues is operating in a double guise. He makes a deal on his own behalf with the originators of the enterprise, and then he makes a separate deal with the public to raise from them the funds he has promised the business. He demands, and no doubt is entitled to, a liberal reward for his pains. But the very size of his compensation introduces a significant change in his relationship to the public. For it makes a very real difference whether a stock buyer can consider the investment banker as essentially his agent and representative, or must view the issuing house as a promoter, proprietor, manager of a business, endeavoring to raise funds to carry it on. When investment banking becomes identified with the latter approach, the interests of the general public are certain to suffer. The Securities Act of 1933 aims to safeguard the security buyer by requiring full disclosure of the pertinent facts and by extending the previously existing liability for concealment or misrepresentation. Although full disclosure is undoubtedly desirable, it may not be of much practical help except to the skilled and shrewd investor or to the trained analyst. It is to be feared that the typical stock buyer will neither read the long prospectus carefully nor understand the implications of all it contains. Modern financing methods are not far different from a magician's bag of tricks. They can be executed in full view of the public without its being very much the wiser. The use of stock options as part of the underwriter-promoter's compensation is one of the newer and more deceptive tricks of the trade. Two examples of new enterprise financing in 1936 and 1939 will be discussed in some detail with the object of illustrating both the character of these flotations and the technique of analysis required to appraise them. Example A. American Bantam Car Corporation, July 1936. This offering consisted of 100,000 shares of 6% cumulative convertible preference stock, sold to the public at $10 per share, its par value. Each share was convertible into 3 shares of common stock. The underwriters received a gross commission of $2 per share, or 20% of the selling price. However, this compensation was for selling effort only, without any guarantee to take or place the shares. The new company had acquired the plant of the American Austin Car Company, which had started out in 1929 with $3,692,000 in cash capital and had ended in bankruptcy. The organizers of the Bantam enterprise bought in the Austin assets, subject to various liabilities, for only $5,000. They then turned over their purchase plus $500 in cash to the new company for 300,000 shares of its common stock. In other words, the entire common issue cost the promoters $5,500 cash plus their time and effort. The prospectus stated, what was an obvious fact, that the preference stock was offered as a speculation. That speculation could work out successfully only if the conversion privilege proved valuable, since the mere 6% return on a preferred stock was scarcely an adequate reward for the risk involved. The character of the risk was shown clearly enough in the enormous losses of the predecessor company. But note that before the conversion privilege could be worth anything, the common stock would have to sell for more than $3 1/3 per share. And in that case, the $5,500 investment of the organizers would be worth over $1 million. In other words, before the public could make any profit, the organizers would have to multiply their stake 180 times. Sequel. By June 30th, 1939, the company had accumulated a deficit of $750,000. It was compelled to borrow money from the RFC, and the preferred stockholder no longer had any equity in current assets. The price of the preference stock declined to $3, but at the same time the common was quoted at 3/4 bid. This meant, if the quoted price could be trusted, that although the public had lost 70% of its investment, the organizers' $5,500 contribution had still a nominal market value of $225,000. Example B. Aeronautical Corporation of America, December 1939. This company offered to the public 60,000 shares of new common stock at $6.25 per share. The underwriters, who made no firm commitment to take any shares, received on the sale of each share the following three kinds of compensation. 1. 90 cents in cash. 2. 1/20th of a share of stock, ostensibly worth 31 cents, donated by the principal stockholders. 3. A warrant to buy 1/2 share of stock at prices varying between $6.25 and $8 per share. If the common stock was fairly worth the $6.25 offering price, these warrants were undoubtedly worth at least $1 per share called for. This would mean an aggregate commission for selling effort of $2.34 per share, or more than 1/3 the amount paid over by the public. The company had been in business since 1928 and had been manufacturing its light Aeronca planes since 1931. Its business had grown steadily from $124,000 sales in 1934 to about $850,000 sales in 1939. However, the enterprise had been definitely unprofitable to the end of 1938, showing an aggregate deficit at that time of over $500,000, including development expense written off. In 9.5 months to October 15, 1939, it had earned $50,000. Prior to this offering of new shares to the public, there were outstanding 66,000 shares of stock, which had a net asset value of only $1.28 per share. In addition to the warrants for 30,000 shares to be given the underwriters, there were like warrants for 15,000 shares in the hands of the officers. There seemed strong reason to believe that the company occupied a favorable position in a growing industry, but analysis would show that the participation of the public in any future increase in earnings was seriously diluted in three different ways: by the cash selling expense subtracted from the price to be paid for the new stock, by the small tangible assets contributed by the original owners for their stock interest, and by the warrants, which would siphon off part of any increased value. To show the effect of this dilution, let us assume that the company proves so successful that its fair value is twice its tangible assets after completion of this financing, say about $1 million as compared with $484,000 of tangible assets. What could then be the value of the stock for which the public paid $6.25? If there were no warrants outstanding, this value would be about $8 per share on 126,000 shares. But allowing for a value of, say, $2 per share for the warrants, the stock itself would be worth only $7.25 per share. Hence, even a very substantial degree of success on the part of this enterprise would add a mere 16% to the value of the public's purchase. Should things go the other way, a very large part of the investment would soon be dissipated. Should the public finance new ventures? fairly complete observation of new enterprise financing registered with the SEC since 1933 has given us a pessimistic opinion as to its soundness and its economic value to the nation. The venturing of capital into new businesses is essential to American progress, but no substantial contribution to the upbuilding of the country has ever been made by new ventures publicly financed. Wall Street has always realized that the capital for such undertakings should properly be supplied on a private and personal basis by the organizers themselves or people close to them. Hence, the sale of shares in new businesses has never been a truly reputable pursuit, and the leading banking houses will not engage in it. The less fastidious channels through which such financing is done exact so high an overall selling cost to the public that the chance of success of the new enterprise, small enough at best, is thereby greatly diminished. It is our considered view that the nation's interest would be served by amending the Securities Act so as to prohibit the public offering of securities of new and definitely unseasoned ventures. It would not be easy to define precisely the criteria of seasoning, for example, size, number of years operation without loss, and it may be necessary to vest some discretion on this score with the SEC. We think, however, that borderline and difficult cases will be relatively few in number, although our second example above belongs perhaps in this category. We should be glad to see the powers and duties of the SEC diminished in many details of minor significance, but on this point of protecting a public incapable of protecting itself, our view leans strongly towards more drastic legislation. Blue sky promotions. In the good old days, fraudulent stock promoters relied so largely upon high-pressure salesmanship that they rarely bothered to give their proposition any semblance of serious merit. They could sell shares in a mine that was not even a hole in the ground or in an invention the chief recommendation for which was the enormous profit made by Henry Ford's early partners. The victim was in fact buying blue sky and nothing else. Anyone with the slightest business sense could have detected the complete worthlessness of these ventures almost at a glance. In fact, the glossy paper used for the prospectus was in itself sufficient to identify the proposition as fraudulent. The tightening of federal and state regulations against these swindles has led to a different type of security promotion. Instead of offering something entirely worthless, the promoter selects a real enterprise that he can sell at much more than its fair value. By this means, the law can be obeyed and the public exploited just the same. Oil and mining ventures lend themselves best to such stock flotations because it is easy to instill in the uninitiated an exaggerated notion of their true worth. The SEC has been concerning itself more and more seriously with endeavors to defeat this type of semi-fraud. In theory, a promoter may offer something worth $1 per share at $5, provided he discloses all the facts and adds no false representations. The Commission is not authorized to pass upon the soundness of new securities or the fairness of their price, except in the case of public utility issues which come under the terms of the Public Utility Holding Company Act of 1935. Actually, it appears to be doing its best by various pressures to discourage and even prevent the more grossly inequitable offerings. But it is essential that the public recognize that the Commission's powers in this respect are severely limited, and that only a skeptical analysis by the intending buyer can assure him against exploitation. Promotional activities are attracted especially to any new industry that is in the public eye. Profits made by those first in the field or even currently by the enterprise floated can be given a fictitious guise of permanence and of future enhancement. Hence, gross overvaluations can be made plausible enough to sell. In the liquor flotations of 1933, the degree of overvaluation depended entirely upon the conscience of the sponsors. Accordingly, the list of stock offerings showed all gradations from the thoroughly legitimate down to the almost completely fraudulent. A somewhat similar picture is presented by the aircraft flotations of 1938 to 1939. The public would do well to remember that whenever it becomes easy to raise capital for a particular industry, both the chances of unfair deals are magnified and the danger of overdevelopment of the industry itself becomes very real. Repercussions of unsound investment banking. The relaxation of investment bankers' standards in the late 1920s and their use of ingenious means to enlarge their compensation had unwholesome repercussions in the field of corporate management. Operating officials felt themselves entitled not only to handsome salaries, but also to a substantial participation in the profits of the enterprise. In this respect, the investment trust arrangements devised by the banking houses for their own benefit set a stimulating example to the world of big business. Whether or not it is proper for executives of a large and prosperous concern to receive annual compensation running into hundreds of thousands or even millions of dollars is perhaps an open question. Its answer will depend upon the extent to which the corporation's success is due to their unique or surpassing ability, and this must be very difficult to determine with assurance. But it may not be denied that devious and questionable means were frequently employed to secure these large bonuses to the management without full disclosure of their extent to the stockholders. Stock option warrants or long-term subscription rights to buy shares at low prices proved an excellent instrument for this purpose, as we have already pointed out in our discussion of stockholder-management relationships. In this field, complete and continued publicity is not only theoretically desirable, but of practical utility as well. The legislation of 1933 to 1934 marks an undeniable forward step in this regard, since the major facts of managerial compensation must now be disclosed in registration statements and in annual supplements thereto, Form 10K. With publicity given to this compensation, we believe that the self-interest of stockholders may be relied on fairly well to prevent it from passing all reasonable limits. Chapter 48. Some aspects of corporate pyramiding. Pyramiding in corporate finance is the creation of a speculative capital structure by means of a holding company or a series of holding companies. Usually, the predominating purpose of such an arrangement is to enable the organizers to control a large business with the investment of little or no capital, and also to secure to themselves the major part of its surplus profits and increased going concern value. The device is most often utilized by dominant interests to cash in speculative profits on their holdings and at the same time to retain control. With the funds so provided, these successful captains of finance generally endeavor to extend their control over additional operating enterprises. The technique of pyramiding is well illustrated by the successive maneuvers of O.P. and M.J. Van Sweringen, which started with purchase of control of the then relatively unimportant New York, Chicago, and St. Louis Railroad and rapidly developed into a far-flung railroad empire. Example: the Van Sweringen Pyramid. The original transaction of the Van Sweringens in the railroad field took place in 1916. It consisted of the purchase from the New York Central Railroad Company for the sum of $8,500,000 of common and preferred stock constituting control of the New York, Chicago, and St. Louis Railroad Company, known as the nickel plate. This purchase was financed by giving a note to the seller for $6,500,000 and by a cash payment of $2 million, which in turn was borrowed from a Cleveland bank. Subsequent acquisitions of control of many other companies were effected by various means, including the following. 1. The formation of a private corporation for the purpose, for example, Western Corporation to acquire control of Lake Erie and Western Railroad Company, and Cloverleaf Corporation to acquire control of Toledo, St. Louis, and Western Railroad Company, both in 1922. 2. The use of resources of one controlled railroad to acquire control of others. For example, the New York, Chicago, and St. Louis Railroad Company purchased large amounts of stock of Chesapeake and Ohio Railway and Pere Marquette Railway Company during 1923 to 1925. 3. The formation of a holding company to control an individual road with sale of the holding company's securities to the public. For example, Chesapeake Corporation, which took over control of Chesapeake and Ohio Railway Company and sold its own bonds and stock to the public in 1927. 4. Formation of a general holding company. For example, Allegheny Corporation, chartered in 1929. This ambitious project took over control of many railroad, coal, and miscellaneous enterprises. The report on the Van Sweringen holding companies made to the House of Representatives in 1930 includes an interesting chart showing the contrast between the control exercised by the Van Sweringens and their relatively small equity or financial interest in the capital of the enterprises controlled. In the accompanying PDF, we append a summary of these data. The figures in column A show the percentage of voting securities held or controlled by the Van Sweringens. The figures in column B show the proportion of the contributed capital, bonds, stock, and surplus, actually owned directly or indirectly by them. It is worth recalling that similar use of the holding company for pyramiding control of railroad properties had been made before the war, notably in the case of the Rock Island Company. This enterprise was organized in 1902. Through an intermediate subsidiary, it acquired nearly all the common stock of the Chicago, Rock Island, and Pacific Railway Company, and about 60% of the capital stock of the St. Louis and San Francisco Railway Company. Against these shares, the two holding companies issued large amounts of collateral trust bonds, preferred stock, and common stock. In 1909, the stock of the St. Louis and San Francisco was sold. In 1915, the Rock Island Company and its intermediate subsidiary both went into bankruptcy. The stock of the operating company was taken over by the collateral trust bondholders, and the holding company stock issues were wiped out completely. The ignominious collapse of this venture was accepted at the time as marking the end of high finance in the railroad field. Yet some 10 years later, the same unsound practices were introduced once again, but on a larger scale and with correspondingly severer losses to investors. It remains to add that the congressional investigation of railroad holding companies instituted in 1930 had its counterpart in a similar inquiry into the finances of the Rock Island Company made by the Interstate Commerce Commission in 1914. The memory of the financial community is proverbially and distressingly short. Evils of corporate pyramiding. The pyramiding device is harmful to the security buying public from several standpoints. It results in the creation and sale to investors of large amounts of unsound senior securities. It produces common stocks of holding companies which are subject to deceptively rapid increases in earning power in favorable years and which are invariably made the vehicle of wild and disastrous public speculation. The possession of control by those who have no real capital investment, or a relatively minor one, is inequitable and makes for irresponsible and unsound managerial policies. Finally, the holding company device permits of financial practices that exaggerate the indicated earnings, dividend return, or book value during boom times, and thus intensify speculative fervor and facilitate market manipulation. Of these four objections to corporate pyramiding, the first three are plainly evident, but the last one requires a certain amount of analytical treatment in order to present its various implications. Overstatement of earnings. Holding companies can overstate their apparent earning power by valuing at an unduly high price the stock dividends they receive from subsidiaries, or by including in their income profits made from the sale of stock of subsidiary companies. Examples. The chief asset of Central States Electric Corporation was a large block of North American Company Common on which regular stock dividends were paid. Prior to the end of 1929, these stock dividends were reported as income by Central States at the market value then current. As explained in our chapter on stock dividends, such market prices averaged far in excess of the value at which North American charged the stock dividends against its surplus, and also far in excess of the distributable earnings on North American Common. Hence, the income account of Central States Electric gave a misleading impression of the earnings accruing to the company. A transaction of somewhat different character but of similar effect to the foregoing was disclosed by the report of American Founders Trust for 1927. In November 1927, American Founders offered its shareholders the privilege of buying about 88,400 shares of International Securities Corporation of America Class B Common at $16 per share. International Securities Corporation was a subsidiary of American Founders, and the latter had acquired the Class B stock of the former at a cash cost of $3.70 per share in 1926. American Founders reported net earnings for common stock in 1927 amounting to $1,316,488, most of which was created by its own stockholders through their purchase of shares of the subsidiary as indicated above. Distortion of dividend return. Just as a holding company's income may be exaggerated by reason of stock dividends received, so the dividend return on its shares may be distorted in the public's mind by payment of periodic stock dividends with a market value exceeding current earnings. People are readily persuaded also to regard the value of frequent subscription rights as equivalent to an income return on the common stock. Pyramided enterprises are prodigal with subscription rights, for they flow naturally from the succession of new acquisitions and new financing, which both promote the ambitions of those in control and maintain speculative interest at fever heat, until the inevitable collapse. The issuance of subscription rights sometimes gives the stock market an opportunity to indulge in that peculiar circular reasoning which is the joy of the manipulator and the despair of the analyst. Company A's stock is apparently worth no more than 25. Speculation or pool activity has advanced it to 75. Rights are offered to buy additional shares at 25, and the rights have a market value of, say, $10 each. To the speculative fraternity, these rights are practically equivalent to a special dividend of $10. It is a bonus that not only justifies the rise to 75, but warrants more optimism and a still higher price. To the analyst, the whole proceeding is a delusion and a snare. Whatever value the rights command is manufactured solely out of speculators' misguided enthusiasm, yet this chimerical value is accepted as tangible income and as vindication of the enthusiasm that gave it birth. Thus, with the encouragement of the manipulator, the speculative public pulls itself up by its bootstraps to dizzier heights of irrationality. Example: between August 1928 and February 1929, American and foreign power company common stock advanced from 33 to 138 7/8, although paying no dividend. Rights were offered to the common stockholders and other security holders to buy second preferred stock with detached stock purchase warrants. The offering of these rights, which had an initial market value of about $3 each, was construed by many as the equivalent of a dividend on the common stock. Exaggeration of book value. The exaggeration of book value may be effected in cases where a holding company owns most of the shares of a subsidiary and where, consequently, an artificially high quotation may readily be established for the subsidiary issue by manipulating the small amount of stock remaining in the market. This high quotation is then taken as the basis of figuring the book value, sometimes called the breakup value, of the share of the holding company. For an early example of these practices, we may point to Tobacco Products Corporation, Virginia, which owned about 80% of the common stock of United Cigar Stores Company of America. An unduly high market price seems to have been established in 1927 for the small amount of cigar stores stock available in the market, and this high price was used to make tobacco product shares appear attractive to the unwary buyer. The thoroughly objectionable accounting and stock dividend policies of United Cigar Stores, which we have previously discussed, were adjuncts to this manipulative campaign. The most extraordinary example of such exaggeration of the book value is found, perhaps, in the case of Electric Bond and Share Company,